And joining us now with her perspective on the latest GDP numbers is Kimberly Amadeo, the author of Beyond the Great Recession. Kimberly, thanks for joining us tonight.
It's my pleasure, Michelle.
So, Kimberly, U.S. gross domestic product, that is the broadest measure of economic activity, grew at a 4.1% annual pace in the third quarter. That was up from the 2.8% pace that was first reported in November. What were the reasons behind the growth in this revision?
Well, there were three reasons which looked good in the beginning, but actually were indications of future softening. And the first is, as you mentioned, the inventory growth, with retailers putting in stock for their expectations of a strong holiday shopping season. And unfortunately, Black Friday and Cyber Monday sales have come in softer than they would like. Now, they're still going to try and push for this last week, but it doesn't look good. The second headline reason for growth is, as you also mentioned, business spending, but most of that was construction, and that was for single-family homes and apartments. Well, these are home builders trying to catch up to the great sales that we saw this year in homes, but that started to soften because interest rates went up this summer. And then the third thing is we have had good retail sales, but when you look behind the numbers, once again, this was mostly auto sales and sales of appliances, furniture, for example, all things that are financed with low interest rates that may be going up next year.
All right, so you think this revision is an anomaly. You do not see this trend continuing given what you've just said.
I think that the fourth quarter is probably, with all that inventory, it's going to drag the numbers down, and I think we're going to see growth more around 2%, which is on the low side of healthy. But I think what's going to happen is that figure doesn't get released until the end of January. I think in the beginning of January, we're going to see December employment numbers to be a little softer than expected, and that's going to make investors a little skittish. You know, the Dow's gone up 24% this year, and it could, we're really due for a pullback, and that could be one of the things that would start to kick us into a pullback, and we might see the Dow start to drop at that point.
I want to focus back a little bit on one of the factors that we saw the increase in the third quarter, and that's consumer spending and consumer purchases, which account for almost 70% of the economy. That did increase 2%. So what were the goods and services that consumers were spending on?
Well, they spent mostly on automotive. They spent on, you know, there were some indications that they spent on services, but when you really looked at the bottom line, there weren't that many services that they spent on. They've been spending on things that they haven't been able to buy for the last 5 years. And now they're finally saying, well, you know what? Interest rates are low. I better go ahead and get that big screen TV that I've wanted. I better go ahead and, you know, get the iPad or some of those, or even appliances and furniture.
So you don't see that spending trend continuing then?
I think we're going to have a little bit of a pullback in the first quarter because, you know, one of the things that's a good sign is that Congress has gone ahead and given us a budget for the next 2 years. And that is, in the long run, going to make businesses more confident in the leadership of the economy. They have money on hand. They're ready to start hiring, but they just needed to see that leadership from Congress. I think that that's going to do well for us in 2014 as a whole. But there are three things that could happen in January and February that could throw us off track. Well, of course, I mentioned those reports that may be a little bit softer. But the other thing is there are still some congressmen who are saying we don't want to raise the debt ceiling. Even though we pass the budget, we don't want to let Treasury pay for that. And so the debt ceiling, we may have another debt ceiling crisis in February. The second thing is we have two.
Well, what would be the effect of the Fed now scaling back its stimulus? How do you see that factoring into GDP in the first quarter and going into the second half of 2014?
Sure. I don't think it's going to have much of an impact. I think most of the interest rate increases that we saw have already happened. So we'll see the 10-year Treasury at about 3%. And I think the markets expect that. That's still historically a low rate, and so we still have plenty of money. That hasn't been the problem. The problem has been confidence in the economy so that businesses can start hiring. and we need to see that hiring so that consumers will put demand back into the economy, will start spending like they used to, and then I think towards the second half of next year, we will see much better growth.
All right, we're going to have to leave it there. Thank you so much, Kimberly Amadeo, author of Beyond the Great Recession.